The federal threshold is $10,000. If you ask 99% of Americans over the age of 60, they will confidently tell you that as long as they keep their bank transactions under $10,000, they are completely off the federal government's radar. They believe that this number is a protective shield. But today, I am here to tell you that the $10,000 rule is nothing more than a decoy. It is a highly publicized benchmark that keeps retirees looking in the wrong direction while the actual mechanism operates quietly, much lower down the financial ladder. The real number that triggers an automated permanent report directly to the Financial Crimes Enforcement Network, a bureau of the United States Department of the Treasury known as FinCEN, is exactly $2,956, not $10,000, not even close. Your bank is not required to tell you this. In fact, under federal law, specifically Title 31 of the United States Code, Section 5318, financial institutions are legally prohibited from notifying you if your account triggers an internal alert. They have every right to file what is known as a suspicious activity report, or an SAR, without ever sending you a letter, without obtaining a warrant, and without making a single courtesy phone call to verify your identity. Once that automated report is sent to FinCEN, it is cross-referenced with your history at the Internal Revenue Service and your Social Security Administration data. And here is the most chilling part of the federal apparatus. Once a suspicious activity report is filed, it cannot be unfiled. It remains in the Financial Intelligence Unit repository permanently. If you are over the age of 60 and you use your checking account to manage everyday expenses, pay off your home, or help your family, there is a very high statistical probability that a flag has already been generated on your name. In this broadcast, we are going to examine 5 critical realities that every retiree must face. First, the exact operational dollar amount you should never exceed in a primary checking account after age 60. Second, an aggressive compliance program that specifically targets individuals over 55 with checking account deposits above thresholds most local branch managers don't even understand. Third, the digital transaction trap tied to Form 1099-K that now sweeps up ordinary retiree behavior like sending money to grandchildren or selling household assets. Fourth, a rarely discussed legal mechanism called civil asset forfeiture under Title 18, which allows the government to freeze checking accounts without a criminal conviction. And fifth, the single most dangerous checking account habit shared by hardworking Americans, one that a landmark study identified as the #1 reason ordinary retirees end up forced to hire specialized counsel at $400 an hour just to get their own money back. I want you to understand that this is not about tax evasion. This is not about complex financial engineering. This is about legal asset preservation. It is about understanding the automated world we live in so that your hard-earned peace of mind isn't compromised by an algorithm. Let me share a case that came across my desk recently, the story of Raymond and Carol. Raymond spent 28 years working as a civil engineer, contributing to his community and carefully building his nest egg. Carol worked part-time, managing their household and ensuring their family was secure. Between their savings and the sale of a conservative property, they accumulated $214,800 in a joint checking account at a prominent regional bank. Raymond did not trust the volatility of the stock market after witnessing the collapse of 2008. He wanted liquidity. He wanted to know that if a grandchild needed tuition assistance or if a medical emergency arose, he could simply write a check. In the spring of last year, Raymond walked into his local branch to withdraw $8,400 in cash. He had a lifelong dream of purchasing a restored 1967 Ford Mustang from a private estate sale. He didn't use a wire transfer because the seller required cash on delivery. The teller, following automated prompts on her screen, asked Raymond a series of routine questions about the purpose of the withdrawal. Raymond, an upright citizen with a spotless record, answered every question politely and transparently. He left the bank, purchased the vehicle, and felt a profound sense of accomplishment. 41 days later, Raymond and Carol received a letter. It wasn't a standard statement. It was IRS Form 2205A, informing them that their federal tax returns for the past 3 years had been selected for a correspondence examination. The trigger? The bank's compliance system had automatically filed an SAR labeling Raymond's cash withdrawal as a potential structured transaction under Title 31, Section 5324. Raymond had no intention of evading any threshold. He didn't even know what structuring meant. Yet that single transaction launched a compliance review that lasted 14 months, required extensive documentation, and cost them $11,200 in representation fees. In the end, they owed $0 additional dollars in taxes. They had done absolutely nothing wrong. But the emotional toll and the financial drain were entirely real. And it happens because the system relies on automated data, not human judgment. To understand why this happens, we must look at how the regulatory environment has shifted. The Internal Revenue Service has dramatically expanded its automated infrastructure through what is known as the High Income Compliance Initiative. While public announcements focused heavily on billionaires and large corporations, the operational manuals tell a very different story. If you examine the Internal Revenue Manual, specifically Section 4.1.7, the criteria for examination include individuals whose gross income or gross receipts exceed $400,000 from any combined source. This includes standard retirement distributions, pension payouts, required minimum distributions from your IRA, and, critically, the gross proceeds from the sale of a primary residence. Consider a senior who decides to downsize. They sell the family home they lived in for 25 years. Because real estate values have scaled over the decades, the transaction easily generates $500,000 in gross proceeds. This transaction is automatically reported to the federal government on Form 1099-S. Even if that retiree qualifies perfectly for the Section 121 exclusion, meaning they legally owe $0 federal capital gains tax on the sale, the automated compliance engine only sees the massive influx of cash hitting a standard checking account. The system flags a direct mismatch between the historical average daily balance and the sudden surge of liquidity. When this mismatch occurs, the system automatically generates a computer-derived notice, such as Form CP2000. The burden of proof immediately shifts to the retiree. You must produce settlement statements, historical cost basis documentation, and formal correspondence to prove that your liquid cash is legitimate. It is a process filled with bureaucratic delays, often leaving funds effectively restricted or under intense scrutiny while the case winds through automated channels. Simultaneously, we are seeing the full deployment of modified digital transaction rules under the tax code. Payment processors, digital wallets, and peer-to-peer applications are now fully integrated into this automated net. The threshold for the issuance of Form 1099-K has been drastically altered. Historically set at $20,000, the current operational framework sweeps up accounts with transactions as low as $600. This form does not care about intent. It cares about volume and categorization. If a grandchild uses a mobile payment application to reimburse you for a shared family expense, or if you sell an old piece of furniture on an online marketplace for $800, that transaction is recorded. If the sender fails to specifically select the obscure personal transfer designation within the application, the processing network reports that gross receipt directly to the IRS as commercial income. The automated matching systems at the service compare your reported income on Form 1040 against the aggregate totals reported by these payment processors. When a discrepancy appears, the system assumes unreported business activity. For a retiree who adopted these digital platforms later in life simply to stay connected with family, the resulting automated notices can be terrifying. The system doesn't see a grandfather receiving a birthday gift or a senior clearing out their garage. It sees an unclassified commercial entity operating outside standard schedules. The sheer volume of these automated notices has escalated exponentially, and a disproportionate share lands in the mailboxes of Americans over the age of 60. There is an even more profound regulatory mechanism that remains completely unmentioned in traditional financial seminars. It rests under the umbrella of federal statutory law, specifically Title 18 of the United States Code, Section 981. This is the framework governing civil asset forfeiture. Unlike criminal forfeiture, which requires a person to be formally indicted, tried, and convicted of a specific crime beyond a reasonable doubt, civil asset forfeiture is an action directed against the property itself. The legal case is not styled as the government versus John Doe. It is styled as the government versus a specific quantity of liquid currency. Under this statute, if an automated compliance system flags a banking pattern that an internal algorithm deems anomalous or characteristic of unverified fund movement, federal or state authorities can initiate an administrative freeze or seizure of those assets based entirely on probable cause or suspicion of non-compliance. No criminal charges need to be filed. No arrest warrants need to be executed. Once the administrative freeze is placed on your primary checking account, the standard presumption of innocence is effectively inverted. The depositor must enter a complex legal arena to prove that the funds were derived from completely legitimate post-tax retirement sources. Data compiled by independent legal institutions, including comprehensive reports from the Institute for Justice, reveal that over $60 billion have been processed through civil forfeiture frameworks over the past 2 decades. When you isolate checking account seizures, a staggering 41% of the affected individuals are ordinary citizens over the age of 60. The median amount frozen in these accounts rests right around $33,000. The exact sweet spot where retirees tend to keep emergency reserves or liquid cash for home maintenance. In the vast majority of these cases, no criminal wrongdoing is ever established, but reclaiming those funds requires significant resources and administrative persistence. Why does a standard checking account become a target for these automated systems? It comes down to an internal metric system used by major financial institutions known as the anomaly core score. Your bank's compliance software continuously monitors the exact ratio between your average daily balance and your documented recurring income sources. For a traditional retiree, documented income is incredibly stable and predictable. It consists of your Social Security distribution verified by federal records, alongside any structured pension or annuity reported on Form 1099-R. If you maintain a permanent fluctuating balance in your primary transaction checking account that is 10, 15, or 20 times greater than your monthly documented income, the software marks that account as an anomaly. The system is programmed to assume that a standard checking account is an operational vehicle, a pipeline meant for paying immediate bills, not a vault for long-term wealth preservation. According to internal compliance guidelines published by major banking associations, the optimal threshold that keeps an account completely clear of the automated anomaly flag is roughly 90 days of documented income. For a retiree receiving an average monthly Social Security benefit of $3,000, the internal monitoring software expects to see an operational checking balance that does not consistently exceed $9,600. When a senior keeps $50,000, $75,000, or $100,000 sitting entirely in a primary checking account without an updated, verified source of funds profile on file, the system continuously generates baseline alerts. Having that volume of cash in a checking account is completely legal, but it turns your account into a beacon for automated compliance reviews. Every small cash withdrawal, every international travel notice, or every transfer to a family member can cause those baseline alerts to escalate into a formal filing. Now that we understand exactly how the automated net operates, we must focus on the solutions. You do not need to live in fear of the system, but you must alter your banking habits to align with modern compliance realities. Here are the 5 definitive strategies that will completely insulate your retirement capital from automated flags. First, establish a strict operational limit for your primary transaction checking account. You should maintain no more than 60 days of verified monthly living expenses in that specific account at any given time. For the majority of American retirees, this means keeping an operational balance between $6,000 and $14,000 in the checking tier. Every single dollar above that operating buffer must be moved out of the primary transaction pipeline. It belongs in a secondary, non-transactional environment, such as a federally insured high-yield savings account or a dedicated money market tier located at a separate financial institution or managed under a distinct custody profile. By drawing a clear line between your bill-paying account and your wealth preservation account, you instantly drop your anomaly core score to 0. The software sees a perfectly balanced operational pipeline, and your account is instantly classified as low risk. Second, you must proactively manage your account's internal documentation file. If you have recently experienced a major liquidity event, such as cashing out a long-term certificate of deposit, receiving a legal inheritance, or finalizing the sale of a piece of real estate, do not simply let that cash land in your account unannounced. Request a formal meeting with your branch's designated compliance officer or senior operations manager, not a standard personal banker who handles retail accounts, but the person responsible for branch compliance. Provide them with a signed, written statement detailing the exact source of the incoming funds, accompanied by supporting legal documents such as a probate distribution order or a certified closing settlement statement. Instruct them explicitly to upload these documents directly into your permanent customer identification profile. This creates an unassailable paper trail within the bank's internal system, effectively blocking the automated software from generating a suspicious activity report when the cash hits your ledger. Third, clean up your digital payment footprint. If you utilize peer-to-peer applications to interact with family or manage casual transactions, you must maintain a dedicated profile used exclusively for personal transfers. Ensure that every family member sending a holiday gift or reimbursing a travel expense explicitly marks the transfer as a personal/gift payment within the application's memo field. If you occasionally sell personal items online, do not route those funds through your personal profile. Maintain a completely separate account for casual marketplace activity and ensure that those transactions are neatly itemized on your annual filings, even if they fall far below the standard reporting limits. This clear separation prevents the automated matching system from triggering a mismatch notice against your Social Security benefits. Fourth, understand your legal rights regarding federal account transparency. While you cannot access active internal bank logs, you have the absolute right under federal law to monitor your standing with regulatory networks. Retirees can utilize formal transparency channels, including specific Freedom of Information Act requests directed to the Department of the Treasury to verify if their accounts have been subject to external inquiries or regulatory flagging. This process is completely legal, entirely free, and provides an invaluable layer of transparency for those managing substantial liquid reserves. Fifth, deploy the statutory protections explicitly granted to you under the Senior Safe Act of 2018, codified under Title 15 of the United States Code. This federal statute was passed by Congress to protect seniors from financial exploitation, but its operational framework can be used to dramatically strengthen your account's security. Submit a formal written request to your financial institution instructing them to apply a Senior Safe Protective designation to your primary account profile. As part of this filing, designate a trusted family member, an independent professional, or a specialized advisor as your authorized secondary contact for compliance reviews. This simple administrative step forces a human element into an otherwise automated system. If the bank's software flags an unusual transaction or a sudden balance shift, the institution is legally incentivized to pause and contact your designated representative for verification before generating an automated federal report. It replaces a cold, unyielding algorithm with a necessary layer of human oversight. My friends, protecting your retirement is no longer just about choosing the right investments or managing your tax brackets. In the modern financial era, it requires a clear, sophisticated understanding of the automated systems that govern our banking network. By restructuring your liquid assets, setting up internal documentation trails, and using federal statutes to your advantage, you can ensure that your hard-earned wealth remains exactly where it belongs, secure, liquid, and entirely under your control. Thank you for your time today. Ensure your assets are aligned with these guidelines, stay vigilant, and continue to safeguard the wealth you worked a lifetime to build.